For decades, JPMorgan did not need to own silver in order to dominate it because dominance in modern finance is not built on possession but on structure, narrative, and timing. And silver was the perfect material for that kind of control. Small enough to be ignored, important enough to be essential, volatile enough to justify intervention, and misunderstood enough that very few people ever questioned why its price behaved the way it did. And as long as silver existed primarily as a financial abstraction rather than a physical constraint, JPMorgan's position remained unchallenged because paper claims could always outnumber metal, contracts could always be rolled forward, delivery could always be deferred, and price could always be managed within a range that preserved confidence without triggering panic. But this entire architecture depended on one silent assumption that was never meant to be tested: that physical silver would never be demanded at scale by an actor that did not care about short-term price signals, quarterly volatility, or Western market conventions. And this is where China enters the story not as a sudden aggressor or dramatic challenger, but as a civilization that views silver through an entirely different lens. One shaped by industrial necessity, strategic planning and long-term survival rather than speculative return. Because to China, silver is not a trade. It is not a hedge. It is not a store of value to be flipped for profit. It is a material input without which modern systems begin to fail quietly and irreversibly. And when a system begins to treat silver as infrastructure rather than inventory, the logic of its pricing begins to break down, because infrastructure demand does not negotiate with markets. It absorbs supply until it is satisfied. And China's industrial expansion has quietly transformed silver from a cyclical commodity into a consumed strategic resource, one that disappears into electronics, power transmission, solar capacity, medical technology, defense systems, and data infrastructure, never to return to the market in meaningful form. And this kind of demand is invisible to paper-based models because it does not respond to price suppression in the expected way. It does not retreat when prices rise, and it does not surge when prices fall. It simply continues steadily, relentlessly, year after year. While JPMorgan's influence over silver has always relied on the opposite behavior. A market sensitive to sentiment positioning and leverage a market where traders respond to signals, not necessity. And this is the first fracture in the illusion of control, because control only functions when participants react predictably. And China does not behave like a participant. It behaves like an allocator, redirecting material flows according to national priorities rather than market incentives. And this means that silver can be leaving the system even while the price appears. Stable inventories can be tightening even while futures curves suggest abundance. And JPMorgan's models can remain internally consistent while drifting further away from physical reality. And this divergence is not dramatic at first. It is subtle, almost unnoticeable. Because the paper market continues to function, contracts continue to trade, liquidity continues to appear deep, but depth is not the same as availability, and liquidity is not the same as supply. And the more silver is embedded into irreversible uses, the more fragile the entire structure becomes. Because a system built on rolling claims cannot survive contact with a system built on consumption, and JPMorgan understands this risk better than anyone, which is why its historical approach to silver has never been about betting on price appreciation, but about dampening volatility, maintaining order, and preventing exactly the kind of disorder that physical scarcity introduces, because scarcity breaks narratives, it exposes leverage, and it forces settlement. And forced settlement is the one thing a paper-dominated market cannot tolerate at scale. But China does not need to force settlement through confrontation. It only needs to make settlement inevitable through accumulation and use. And this is what makes the current shift feel less like a financial rivalry and more like a slow-motion structural realignment, because JPMorgan's power exists primarily within systems it helped design, exchanges it understands, regulations it can navigate, and counterparties that share its assumptions, while China's silver strategy operates largely outside those systems, embedded in bilateral trade agreements, domestic production planning, strategic stockpiling, and long-term industrial policy, none of which require participation in Western price discovery mechanisms. And this creates a situation where JPMorgan can continue to dominate the visible market while gradually losing influence over the invisible one, the market where silver actually ends up. Because price only matters if it determines allocation, and allocation is increasingly being decided elsewhere, quietly, administratively, strategically, and this is why the idea of China attacking JPMorgan misses the point entirely. Because there is no attack, no confrontation, no headline moment. There's only a steady withdrawal of relevance, a slow erosion of the conditions that made control possible in the first place. And the most unsettling aspect of this process is that it does not require JPMorgan to make a mistake. It only requires the world to change in a way that renders its strengths less effective. Because JPMorgan, or S, dominance over silver, was built for a world where financial abstraction could override physical constraint indefinitely. But history suggests that abstraction always collapses back into reality eventually, and silver is one of the few materials where that collapse cannot be delayed forever, because you cannot print conductivity. You cannot synthetically replace silver at scale without cost. And you cannot indefinitely suppress the price of a material that is being structurally consumed by the largest manufacturing base on Earth. And China's role in this story is not that of a villain or a hero, but of a catalyst, a force that accelerates the return of physical truth to a market that has spent decades avoiding it. And JPMorgan may still appear powerful, influential, and dominant on paper, but power measured in contracts loses meaning when the underlying material quietly migrates into systems that do not recycle it back into circulation. And this is where the story begins to feel cinematic, almost unreal, because nothing looks broken on the surface. The charts still move. The analysts still speak, the reports still publish. Yet beneath it all, the foundation is thinning atom by atom, shipment by shipment, factory by factory. And the market does not panic, because panic requires visibility, and this process is largely invisible, and by the time visibility arrives, it may no longer matter, because control is not lost in moments of crisis. It is lost in periods of apparent normality when attention drifts and assumptions harden. And China's relationship with silver has always been patient, methodical, and indifferent to Western narratives, which makes it uniquely incompatible with JPMorgan's model of influence, because influence without ownership only works when the underlying asset remains abstract, liquid, and negotiable, and silver is quietly becoming none of those things. And this is why the question is not whether JPMorgan will lose control of silver overnight, but whether control can survive a world where silver is treated as a strategic necessity rather than a speculative instrument, because when markets stop responding to price and start responding to survival, the rules change without warning, and the end of control does not arrive with a crash. It arrives with silence, a moment when price no longer commands behavior, when suppression no longer creates supply, and when the market continues to function even as its authority evaporates. And this is the quiet end. Not announced, not celebrated, not resisted, simply absorbed into reality the way all deep structural shifts occur. To understand why the balance of power in silver is shifting away from JPMorgan without noise or confrontation, it is necessary to move deeper into the machinery that made its control possible in the first place, because JPMorgan did not dominate silver through brute force or outright monopoly. It dominated silver by mastering the architecture of paper representation, a system where ounces exist more often as obligations than as atoms, where futures contracts, options, swaps, and unallocated accounts collectively create the impression of abundance while relying on the assumption that only a small fraction of participants will ever request physical delivery. And this assumption is not accidental, it is foundational, because paper-silver markets are not designed to distribute metal. They are designed to distribute exposure, hedging capacity, and price signals. And JPMorgan became powerful not by breaking the system, but by perfecting it, by providing liquidity where others hesitated, by absorbing risk when volatility surged, and by positioning itself as both a stabilizer and a gatekeeper, a role that grants enormous influence without requiring ownership of the underlying material. But this influence has a critical vulnerability, one that does not appear on balance sheets or regulatory filings, because the entire structure depends on a predictable imbalance between claims and reality, a gap that must remain psychologically acceptable and physically untested. And China's relationship with silver threatens that balance not through aggression, but through indifference, because China does not need paper silver, it needs silver itself. And when an actor enters the market whose primary objective is physical acquisition and consumption rather than exposure or yield, the logic of paper dominance begins to erode from the edges inward, because paper markets can tolerate almost any amount of speculation but very little sustained delivery pressure. And delivery pressure does not announce itself with headlines. It accumulates quietly through small, persistent actions, increased physical offtake, longer delivery timelines, higher regional premiums, and gradual inventory migration away from transparent vaulting systems. And this is where the story becomes less theoretical and more unsettling, because JPMorgan's tools are extraordinarily effective at managing price behavior, volatility spikes, and speculative excess, but they are far less effective at reversing physical flows once those flows are driven by non-market imperatives, because you can suppress price, but you cannot suppress usage. And China's silver demand is usage-driven, not investment-driven, meaning it does not disappear when prices fall, nor does it pause when prices rise. It simply continues as long as industrial planning requires it. And industrial planning in China operates on timelines that dwarf quarterly earnings, cycles, and market sentiment, which means that even sustained price suppression does not deter accumulation. It merely transfers metal from one side of the world to the other at a discount. And this creates a paradox that paper-dominated systems are ill-equipped to handle, because the very mechanisms used to control price also facilitate physical drain, and JPMorgan cannot openly restrict physical silver from leaving the system without exposing the fragility of the structure it seeks to preserve, because restriction implies scarcity, and scarcity undermines confidence, and confidence is the true collateral of paper markets. So instead, the system relies on opacity, complexity, and time, hoping that demand remains elastic and that consumption does not overwhelm recycling and substitution. But silver is uniquely resistant to substitution, because while alternatives exist in theory, they fail at scale or impose performance and reliability costs that modern systems cannot tolerate. And China AS manufacturing ecosystem is large enough that even marginal increases in silver intensity translate into enormous absolute demand that does not circulate back into the market once absorbed. Because much of it is embedded in products with long lifespans or irreversible use cases, and this is where the pressure becomes cumulative rather than cyclical, because every year of continued consumption tightens the physical base upon which paper claims rest, and JPMorgan OS ability to manage this tightening depends on its ability to maintain the perception that sufficient metal exists somewhere accessible if needed, even if it is rarely touched, but perception begins to fail when delivery timelines stretch. When regional premiums detach from futures prices, and when physical market participants stop using paper prices as authoritative signals, because at that point, price loses its coordinating function, and markets without coordination begin to fragment, and fragmentation is lethal to centralized control, because control requires a single reference point, a shared belief in what silver is worth and where it can be obtained, and China OS quiet accumulation strategy undermines this belief by creating parallel channels, where silver moves according to bilateral agreements, domestic allocation, and strategic reserve decisions rather than exchange-based discovery, and these channels are largely invisible to Western market participants until their effects become unavoidable. Because physical silver leaving the system does not ring a bell. It simply fails to return. And JPMorgan's historical strength has been its ability to intermediate between producers, consumers, and speculators, smoothing flows and dampening shocks. But intermediation loses power when one side no longer needs the intermediary and China's scale allows it to bypass traditional channels entirely, sourcing metal through long-term contracts, domestic mining, recycling infrastructure, and strategic partnerships that prioritize certainty over price optimization. And this bypass does not need to be complete to be effective. It only needs to be large enough that the remaining market becomes thinner, more sensitive, and more dependent on confidence, because thin markets amplify the consequences of any disruption. And disruption is inevitable when physical and paper realities diverge too far. And JPMorgan is acutely aware of this, which is why its silver strategy has historically emphasized maintaining deep liquidity in orderly markets. But liquidity is not a substitute for supply, and order is not a substitute for availability. And when industrial demand continues to absorb silver regardless of price, the system enters a state of managed tension, where stability is maintained only through constant intervention and confidence management. And this state can persist longer than many expect, which is why the end of control rarely looks dramatic, because it does not arrive as a failure. It arrives as a loss of effectiveness, a point where interventions produce diminishing returns, where price suppression no longer induces supply, and where market signals increasingly fail to influence real-world behavior. And China's role in this process is not to trigger collapse, but to accelerate irrelevance, because JPMorgan's influence is maximized in markets that everyone must use, and minimized in markets that can be bypassed. And silver is becoming increasingly bypassed in its physical dimension, even as its paper dimension remains active and visible, and this split creates a surreal condition where two markets coexist, one loud and financial, one quiet and material. And the danger for JPMorgan is not that the loud market disappears, but that it continues operating after it has lost its authority over the quiet one, because at that point, price becomes commentary rather than command. And the institution that once shaped behavior finds itself reacting to flows it no longer directs. And this is why the question of control cannot be answered by looking at charts alone, because charts reflect trades, not transformations, and the transformation underway in silver is structural, driven by long-term industrial logic, rather than short-term financial incentives. And once such transformations reach a certain scale, they cannot be reversed by policy adjustments or market operations, because they are embedded in factories, grids, and infrastructure that do not unwind when sentiment shifts. And JPMorgan may continue to manage volatility, provide liquidity, and appear indispensable within the financial layer of the market. But indispensability within an abstraction loses meaning when the underlying material quietly migrates beyond reach. And this is the core tension of the silver market today. Not a battle of prices, but a divergence of realities. One governed by leverage and perception, the other by atoms and necessity. And history suggests that when these realities collide, the outcome is never negotiated. It is simply revealed, often long after the decisive moves have already been made. There's a moment in every controlled system when the instruments designed to stabilize it begin to reveal its weakness. And in the silver market, that moment does not arrive with a crash or a scandal. It arrives with friction, small delays, subtle premiums, extended delivery windows, and quiet rule adjustments that are explained away as temporary anomalies, because systems of control do not fail loudly at first. They fail by becoming less responsive to their own signals. And JPMorgan's influence over silver has always relied on responsiveness, the ability of price movements, futures curves, and liquidity injections to influence physical behavior. But once silver begins to move according to strategic necessity rather than market incentive, responsiveness decays, and decay is difficult to measure because it does not announce itself. It accumulates. And the most dangerous accumulation is delivery risk, not because delivery failures are common, but because the system is built to avoid testing delivery at scale, and JPMorgan's dominance exists precisely because large-scale delivery has been culturally and structurally discouraged, replaced by cash settlement, rollovers, and synthetic exposure. But China's interaction with silver increasingly bypasses these conventions. Because it does not seek exposure, it seeks certainty, and certainty requires possession, and possession at scale introduces a pressure that no paper system can absorb indefinitely without revealing its limits. Because delivery is binary, metal either exists where it is claimed to exist or it does not. And while the market can tolerate ambiguity for long periods, it cannot tolerate sustained ambiguity when physical demand continues to rise. And this is where strategic stockpiling enters the picture, not as a dramatic hoarding event, but as a methodical, policy-driven process that operates beneath market noise. Because China does not announce its accumulation strategies in real time, it reveals them years later, if at all, and this opacity is not accidental, it is strategic. Because markets react to visibility, not to reality, and by the time visibility arrives, reality is already fixed. And strategic stockpiling alters the silver market in a way that price-based analysis struggles to capture. Because stockpiles do not circulate, they do not respond to arbitrage, and they do not re-enter the market when prices rise, which means that any silver diverted into long-term reserves is effectively removed from the pricing mechanism entirely, shrinking the float without changing the headline supply numbers, and this shrinking float increases the sensitivity of the remaining market to shocks, even as price remains subdued through paper mechanisms, creating a condition of latent instability, where the system appears calm precisely because tension is being continuously absorbed. And JPMorgan's role in this environment becomes increasingly paradoxical because its interventions are successful in suppressing visible volatility while simultaneously masking the accumulation of invisible stress. And this is not a failure of intelligence or competence, it is a structural limitation, because no amount of market sophistication can create silver that has been consumed or sequestered, and China's industrial and strategic demand does both, consuming silver irreversibly in manufacturing, while sequestering additional amounts into reserves that do not respond to price. And this dual drain accelerates the divergence between paper representations and physical availability. And divergence eventually leads to decoupling, not necessarily in headline prices at first, but in behavior, because physical buyers begin to treat futures prices as reference points rather than commands, negotiating premiums, securing long-term contracts, and prioritizing reliability over spot pricing. And when enough physical participants behave this way, price loses its authority as a coordinating signal, and coordination is the essence of control. Because without coordination, markets fragment into parallel realities, and fragmentation undermines any centralized influence, including JPMorgan's, because its power is maximized when it can act as a hub, an intermediary through which flows pass and prices are harmonized. But when silver flows increasingly bypass centralized exchanges and move through bilateral or state-directed channels, the hub loses relevance, and this loss is difficult to detect because the paper market continues to function, volumes continue to trade, and liquidity continues to appear ample, but appearance is not substance. And the most dangerous moment for a control system is when it continues operating smoothly after it has lost its connection to the underlying reality, because at that point its signals no longer shape outcomes. They merely describe a shrinking subset of activity. And this is where the silver market begins to resemble a work of financial science fiction, because two worlds coexist without fully interacting. One where JPMorgan and other financial institutions manage price behavior with extraordinary precision, and another where silver is allocated, consumed, and stored according to a strategic logic that does not require market validation. And China's scale ensures that this second world is not marginal. It is dominant in terms of physical impact, even if it remains understated in terms of visibility, and delivery risk becomes the thin membrane separating these worlds, because delivery is the only moment when paper claims must confront physical reality. And as long as delivery remains rare, the system holds. But the more silver is removed from circulation, the more sensitive delivery becomes, and sensitivity increases the cost of failure, which incentivizes further avoidance, reinforcing the paper-centric model even as its physical base erodes. And this feedback loop can persist for long periods, creating the illusion of permanence, but it also creates fragility, because once a threshold is crossed, adjustments must be made quickly, often under conditions of stress, and JPMorgan's ability to manage such adjustments depends on the availability of physical buffers that are becoming thinner as silver is embedded into China's industrial expansion. And this is where price decoupling becomes not a theoretical possibility, but a functional reality. Because decoupling does not require futures prices to explode, it only requires physical prices to stop responding proportionally to develop persistent premiums, regional distortions, and contractual rigidity. And these distortions signal a loss of integration, a breakdown in the assumption that a single price governs the market. And once that assumption fails, control becomes local rather than global, negotiated rather than imposed, and JPMorgan's global influence weakens accordingly, because global control requires global integration, and integration cannot survive sustained divergence between paper and physical domains. And China's role in accelerating this divergence is not dramatic, it is procedural, embedded in policy decisions that prioritize security of supply over market efficiency. And these decisions accumulate effects over time that no single market intervention can reverse. And this is why the most significant threat to JPMorgan-S silver dominance is not a sudden squeeze or a spectacular default, but the gradual normalization of a world where silver pricing is advisory rather than authoritative, where physical allocation decisions are made independently of futures curves, and where the market continues to operate even as its influence over reality diminishes. Because when markets lose their ability to command behavior, they become narratives rather than mechanisms. And narratives, no matter how sophisticated, cannot substitute for atoms. And this is the quiet moment when control begins to slip, not announced, not resisted, simply outgrown by a system that no longer needs it. And by the time this loss becomes visible, it will not look like defeat. It will look like irrelevance. And irrelevance is far more difficult to confront than opposition, because it offers no battlefield, no enemy, only the realization that the world has moved on. In the final stage of any long transition of power, the most important changes are the ones that feel anticlimactic, because history rarely ends with a decisive blow. It ends with a recognition that the rules no longer work the way they used to. And in the silver market, the future does not arrive as a single event, but as a condition, a new normal in which price continues to exist while authority quietly dissolves. And this is the outcome toward which the current trajectory points, not a dramatic collapse of JPMorgan's influence, but its gradual confinement to a shrinking domain, a financial layer increasingly detached from the material flows that actually shape the world. Because JPMorgan's strength has always been its ability to operate within complexity, to manage layered systems of contracts, regulations, and counterparties with extraordinary precision. But complexity is only powerful when it governs something essential, and silver is becoming essential in a way that resists complex abstraction. Because its role in energy transition, electrification, data infrastructure, and military resilience is expanding faster than the financial system's ability to virtualize it. And China-S long-term planning magnifies this effect by embedding silver demand into national strategy rather than market cycles, creating a future where silver allocation decisions are increasingly insulated from price signals. And when price loses its ability to allocate resources, markets do not disappear. They become ceremonial, continuing to function as reference points, while real decisions occur elsewhere. And this is where the story becomes unsettling. Because ceremonial markets can persist for a very long time, giving the impression of continuity even as their relevance fades, and JPMorgan may remain a dominant presence within this ceremonial structure, publishing research, providing liquidity, shaping narratives, and influencing sentiment. But influence over sentiment is not the same as influence over supply. And supply is where power ultimately resides, because supply determines who can build, who can defend, who can electrify, and who can sustain technological advantage. And China's silver strategy is aligned precisely with these objectives, not with financial dominance for its own sake, but with material sufficiency in a world moving toward higher electrical intensity and systemic fragility. And this alignment creates a future where silver is increasingly treated as a strategic constraint rather than a tradable surplus. And constraint-based systems behave differently from surplus-based ones because they prioritize reliability over efficiency, redundancy over optimization, and security over price discovery. And these priorities do not require JPMorgan's traditional services because they do not rely on market clearing or speculative participation. They rely on guaranteed access, long-term contracts, and state-directed allocation. And once enough of the world operates under these priorities, the remaining market becomes a residual space, Important, but no longer decisive, active, but no longer authoritative. And this is the quiet end implied in the title. Not an end marked by loss or failure, but an end defined by irrelevance, where control persists only within a system that no longer commands the material it represents. And this outcome does not require JPMorgan to lose credibility or competence. It only requires the world to stop asking the market what silver is worth in practical terms, because practical worth is increasingly measured in system resilience rather than price efficiency. And China's advantage lies not in secrecy or manipulation, but in scale and patience, because it can afford to plan in decades rather than quarters, to absorb inefficiencies in exchange for certainty, and to allow markets to continue functioning even as they become less central to decision-making. And this patience is what makes the transition so difficult to counter, because there is no single policy lever to pull, no intervention to unwind years of physical embedding, and no market operation that can retrieve silver once it has been consumed by infrastructure. And JPMorgan's future role in this environment may remain significant but fundamentally altered, shifting from a position of control to one of accommodation, adapting to a world where silver prices are influenced more by geopolitical alignment, industrial planning, and strategic reserves than by futures positioning or speculative flows. And this adaptation does not imply defeat, but it does imply a loss of primacy, a recognition that the silver market has grown beyond the framework that once defined it. And this recognition may arrive slowly through subtle changes in behavior rather than explicit acknowledgement, because institutions rarely announce the limits of their own power. They discover them through experience, through moments when familiar tools produce unfamiliar results, when interventions stabilize markets but fail to influence outcomes, and when price movements no longer elicit expected responses from physical participants. And by the time these moments accumulate into clarity, the transition is already complete. And the world moves forward under new assumptions, because financial history is not written by those who control markets. It is written by those who control materials, and silver's role in the coming decades ensures that material control will matter more than ever. In China's quiet accumulation, consumption, and allocation of silver positions, it not as an aggressor, but as an architect of this new reality, one in which JPMorgan's influence remains visible but bounded, powerful but contextual, and ultimately secondary to forces that operate outside the screen, outside the exchange, and outside the narratives of finance. And this is why the story ends not with a question of who wins, but with an observation of how power changes form. Because power does not disappear, it migrates from price to possession, from leverage to logistics, from volatility to volume, and from markets to material. And when that migration is complete, the charts still move, the trades still clear, and the institutions still stand, but the center of gravity has shifted quietly, irreversibly, and without asking permission, leaving behind a silver market that looks familiar but behaves differently, and a system of control that still speaks loudly even as fewer and fewer decisions are listening.